This is the current federal tax developments for the week of May the 18th, 2026. Current federal tax developments are brought to you by your state society of CPAs. Ed Zollers, and we'll be going this week over some of the more significant federal tax developments that have taken place in this past week. So let's take a look at basically the various things we're going to talk about today. We're going to first review the technical framework of newly proposed regulations establishing accepted fertility benefits for various health plans provided. Second, we will look at the strict terms and tight deadlines of the IRS's new time-limited settlement initiative for syndicated conservation easement disputes. That's something which had been announced by the IRS when we talked about previously. Now they're actually telling us what the terms are in that thing. Third, we're going to analyze a recent tax court decision that demonstrates the very severe consequences of failing to strictly comply with the contemporaneous written acknowledgment requirements for charitable land contributions or any contribution of any sort. That is probably the biggest foot fault we see, and how the IRS wins by far the largest number of charitable cases that aren't syndicated conservation easements. And then finally, we'll discuss the Dillon Trust Company versus United States appellate decision, which is a warning about transferee tax liability and the danger of being willfully blind when selling a closely held C corporation in a deal that you reasonably should figure out is going to leave a bankrupted entity, that when it sells the assets and then distributes the benefits out, is not going to be able to pay the tax. So the inside gain will never have tax paid. You got a supposed stock sale, and we're going to discover that, well, if you know all of that, you can be liable even though you weren't the one that was executing the bad strategy, or let's say the strategy that failed, in terms of being able to supposedly cover up that huge gain with this loss that somehow you managed to put inside that corporation. That's usually how these are structured. So we'll talk about that. Bottom line, the Dillon case lost on appeal. So we'll talk about, in that case, as they lost at the trial court level. But let's start with happier things, I suppose, first. We're going to talk about the joint proposed regulations under Reg 118-484-25 that were issued on May 11th, that were issued by Department of the Treasury, the IRS, Department of Labor, and Department of Health and Human Services. These are all involved with this. The core objective of these rules is to classify certain employer-sponsored fertility benefits as a new category of limited accepted benefits. That takes them out of basically the coverage involved with, or the issues involved with coverage under the Affordable Care Act. So this classification is valuable because it generally exempts all of these from, those requirements and where they were. The market requirements found in Chapter 1 of the Internal Revenue Code, Part 7 of ERISA, and Title 27 of the Public Health Services Act. So let's talk about the demographics that are driving this shift. The regulations start out by justifying them by noting the United States experienced a 14% decline in general fertility rates between 2014 and 2024. And as of 2023, the total fertility rate had dropped to just 1.6 births per woman, remaining well below the 2.1 replacement level required for a population to sustain itself. So they're getting worked up about that. These regulations respond to the executive policy directives, specifically Executive Order 14-216, aimed at making in vitro fertilization treatment more affordable, and Executive Order 14192, focused on alleviating regulatory burdens. So historically, major medical plans have lacked comprehensive fertility coverage. And not necessarily something that just happened when we got the Affordable Care Act. Let's be honest. They just generally haven't offered that option. But by creating this limited accepted benefits, the agencies hope to reduce the regulatory friction for employers who wish to offer standalone reproductive health benefits. Now, it's one thing to say, hey, look, we got rid of this burden. It's going to be a whole nother thing to get employers to offer. But that's a whole different discussion. Let's talk about this. Let's assume you have a client or you're a business, you're interested in this. What exactly is being proposed? Well, the statutory basis for these new rules came from Internal Revenue Code section 9832C2C, which allows the agencies to formally recognize similar limited benefits as being accepted benefits. So, the structural requirement to qualify, the fertility benefit must either be provided under a separate insurance policy or otherwise not an integral part of the primary group health plan. Okay. If it's in the group health plan, it would have to be part of, covered under the market coverage rules, all those issues. Now, the scope of the coverage is strictly confined. Substantially all benefits must be for the diagnosis, mitigation, or treatment of infertility or infertility-related reproductive health conditions. That's one of the issues with accepted benefits. You can't backdoor a health plan through this, nice little loophole, let's say. It's got to be strictly limited to looking at these issues. Employers do have flexibility, though, in plan designs if you stay within those boundaries. They allow coverage for services ranging from basic fertility counseling and lab tests to advanced assisted reproductive technology like in vitro fertilization. I'll get that eventually. Provided the services are directed by authorized medical professionals. So these are the key offers. Now, there are some financial and structural limitations to the proposal. First, the dollar cap. To ensure the fertility benefit remains limited benefit similar to the accepted dental or vision plans, which, by the way, you'll probably notice a lot of employers don't offer those either, but that's a separate issue. The proposed regulations impose a strict financial ceiling. Proposed Treasury Regulation 54.9831-1C3IX, and then B, Cap B, mandates a lifetime benefit of $120,000 per participant, which includes their beneficiary. So that's basically family, right? So the whole group is limited to that. Now, there is an inflation adjustment, right? And the department selected the $120,000 threshold because in vitro fertilization treatment often require multiple cycles and can easily cost between $40,000 and $60,000. To prevent this benefit's value from eroding, the maximum benefit will be indexed for medical inflation tied to the CPIU for any plan year beginning after December 31st, 2027. Once a participant exhausts this limits, no further accepted benefits can be provided. Now, there are self-funded plan rules, get that out too, for a self-funded arrangement where the employer is going to fund it on their own, that do not use a separate insurance policy. The benefit cannot be an integral part of the primary medical plan. Practical standpoint, this means plan participants must have the option to decline the primary group health coverage while still enrolling in a fertility benefit, which is useful for employees who are covered under a spouse's medical plan. You can't force them into your group plan in order to allow them to use this benefit. They have to be able to separately choose it. That's also one of the quirks of being an accepted benefit. So please understand that. So for the self-funded plans, yeah, you're going to have to do it. And you can't say you only get in here if you have medical coverage. Now, you got to let them in that case. Okay. There are written notice requirements. We'll talk about that. You got to make sure anybody looking to do one of these, sponsor such a plan, must strictly provide written disclosure rules under proposed regulation 549831-1. This notice must be easily understood by the average participant and detail the coverage, summary of benefits, lifetime dollar limits, network provider identification, and claim submission procedures. These notices must be provided at the initial enrollment date, annually thereafter, and upon request. Now, these proposed rules apply to plan years beginning on or after January 1st, 2027. Note, there is no explicit safe harbor permitting early reliance on these proposed regulations. While the departments have solicited comments on allowing immediate implementation upon finalization, you got to warn your clients that utilize this exemption to provide Chapter 100 market requirements before final rules or interim guidance are published carries significant, huge compliance risk because, remember, proposed regs never have to become final, and technically we need these regs to allow this to happen. So don't go setting them up now. Rather, you can plan for what you're going to do if a client or your company really wants to set one up, but don't pull the trigger until you get further guidance from the agencies indicating that it is now safe to do it. That's going to be key. Now, again, in our you can download the slides from our website, currentfieldtaxdevelopments.com, going to the audio and video updates page. Or if you're watching the video version of this, you'll see it here. We have our infographic, right, which kind of explains how this would work, right? And there are four main pillars: limited scope of care, the lifetime cap on benefits that starts at $120,000, mandatory notice rules, and the effective date would be 2027 right now. Maybe it'll be accelerated forward, but there's no guarantee. Well, true, two things. There's no guarantee it will actually take effect in 27, right? It's a proposed effective date. Proposed means we don't have it yet. Second, even if we do get the proposed go final, there's no commitment here to actually let it go early. In fact, it's not clear how much demand there would be for it to go early because it's going to take time to set these things up. But if your client really, really, really wants to do this right now, just kind of, keep your mind, keep your eyes open for what's happening. And also, we have the bottom comparison chart here. It's administrative differences between accepted fertility benefit and a major medical plan, noting that an accepted benefit is generally exempt from the Affordable Care Act market reforms, but permits strict lifetime dollar limits. Again, remember, those are both problems with having it in the main plan. So we're there. Now let's move on to the second major update, which is really relevant if you're representing partnerships or investors that are caught in syndicated conservation easement audits or litigation. On May 13th, the IRS announced the previously kind of announced by Ken Keyes a while back, a time-limited settlement opportunity via News Release 2026-65. This initiative provides structured terms that simply alter the landscape for resolving these disputes at the partnership level. So again, News Release 2026-65, issued on May the 13th. What exactly did the IRS say? Now, for context, the IRS and courts have aggressively targeted syndicated conservation easements under Section 170H1, challenging them primarily for gross valuation misstatements. And frankly, the IRS has been winning these cases consistently, and we have not yet seen anyone successfully go to the Court of Appeals and get one of these reversed. This has been a total disaster because, to be frank, and you'll know if your client is exposed, even if the exam hasn't started on the partnership yet, if in fact they were offered an opportunity to invest in a partnership and were guaranteed, you give me $10,000 and I'll give you a $500,000 write-off. Yeah, making that work, that's exactly what these were aimed at. Now, the Secure Act 2.0 essentially shut down the really aggressive versions. In essence, it's automatically no deduction if we get a 3.5 or higher multiplier, unless you've held the property for 3 years. There are a number of other limitations that get around that, but that effectively shut down what was being marketed heavily. But those heavily marketed cases are now going through the courts. And there are a ton of these cases that are already, under exam or docketed to go to the tax court. Now, as noted, the IRS in this case just has commanding strength in litigation. These cases, it's rote. We've talked about them multiple times. The tax court is on average only allowed 6% of the original claim deduction and regularly imposes the 40% gross valuation misstatement penalty. And I have told you multiple times, keep that one in mind. That penalty is automatic the minute there is a court holding that your claim deduction, basically your claim value for that charitable contribution was more than twice the actual value of the property. Remember, the court sets the value, period. The judge, I don't care. The judge is not a valuation expert, is going to tell me. That's nice, but irrelevant. Ultimately, judges set this value. That's how the system works, for better or worse. And the judges aren't buying these, give us $10,000 today, and we will somehow say that your $10,000 bought property that giving only a conservation easement on a little over a year later is now worth $500,000. They're not buying it, guys. They haven't been buying it. They've been losing it. As I recall, we had a case last week, right? We talked about same problem. This is not going well, right? Now, the IRS had prior initiatives in this area to settle them. The IRS has offered settlements since 2020, but those older programs required taxpayers to pay penalties on their underpayments up front and entirely disallowed any charitable deduction, allowing only out-of-pocket costs. So, the IRS is now going to change. This is a little unusual. Normally, and we'll see if this has a bad effect going forward, because it may. There's a reason why most taxing agencies, that includes at the state level, have rarely given you a better deal if you don't take the first opportunity to, settle the matter under a big program. But in this case, the IRS is concerned about the number of cases that are piling up, and people are going to court. And at least the apparent conclusion is, why do people keep going to court and then just getting hammered by the tax court? And the idea being is because the current settlements are such that essentially the promoters are not about to really offer them to their participants, because it pretty much ensures, right, that they're going to get taken to the cleaners, because it's going to be a big upfront payment. They need that money, and you can understand the problem. So to overcome these barriers that discourage participation, the new initiative specifically eliminates the upfront payment requirement for many cases, subjecting the liability to post-settlement collection instead. So it means we will settle, you will agree it's X, and then the IRS will go to collect it. As opposed to today, if you want to settle, you've got to give all the money in there up front. Now, the IRS noted there are currently over 1,100, pending conservation easement cases. This initiative targets specific group within that pool. Nearly 450 cases who now get relief from upfront payments, as many as 500 cases where prior settlement offers expired or rejected, and up to 175 new participants who previously lacked an opportunity to settle. Now, advise your clients they should not preemptively contact the IRS, according to this release. Eligible partnerships will receive individualized settlement letters detailing their specific terms on a rolling basis. You got to wait your turn and see exactly what you're offered if you're the partnership. Practitioners must be aware the eligibility is heavily restricted by the procedural posture of the case. Cases are entirely excluded if they have been tried and are waiting an opinion. If you have had your day in court, you just don't know the answer yet, you're not eligible for this. We're not going to settle at this. We're going to let the court rule, because IRS is in pure strength there. Again, they have not lost one of these, right, on these terms. They are winning every time. So if you went all the way to trial, you decided to roll the dice, we're going to see how the dice come out, because the IRS happens to believe the dice are loaded in their favor. That's just a practical read of this, right? Okay. They're also excluded if they've already settled. If you've agreed to a settlement, they're not going to bring you back in and allow this, right? If they're scheduled for trial within 30 days, again, the IRS now is prepped. They've done everything. You cast your die, you're stuck. Or designate as test cases unless all bound cases also settle. Sometimes you'll have a group of cases that are similar. We will designate one case as the test case, and that test case will bind all of the others. Well, in this case, if that test case partnership now wants to settle, everybody else has to be bound by the settlement for the test case. Ultimately, the IRS retains discretion or eligibility based on case-specific administration. So what we really have here, to be totally honest, is the general outline of what they're going to do, but not your specific offer. Keep that in mind. Okay. Now, there are terms, there are deadlines here. There's an initial 90-day window and a 45-day additional window. Right. This timeline is strictly enforced, and it begins on the postmark date or date of electronic transmission of the individual IRS settlement letter. So 90 days from the date of postmark on that letter, if you get it by mail, or on the date of electronic transmission, if you get it transmitted electronically to you by the IRS. 90 days from then is essentially your main settlement window, right? If you elect within the initial 90 days to follow the settlement, the terms are as follows. No charitable contribution will be allowed, number one. Number two, an other deduction is permitted, generally equal to out-of-pocket costs, which IRS notes is often based on cash contributed amounts reflected on the M2. So far, we're not getting a major change. The severe 40% misstatement penalty under 6662H is mitigated down to 10%. That is a significant concession, right? That 40% penalty. Remember, we're not just going to pay back the tax we saved. We're going to pay back 40% more. Now, in this case, we're going to pay back 10% more. And while that's not great, it's way better than 40 and even better than a 20% penalty that would apply had you been more than 150% over the real value, or determined value by the court, but less than 200. So it's there. And then finally, the big concession, no payment is required at the time the partnership elects into the initiative. So we don't need upfront money. And I suspect that got in the way of a lot of these settlements, right? Because you got to probably get the money now from the partners. And whether it was a TEFRA case or a BBA case, it's not going to be easy to get all the partners to agree to do it. Now, what about the resolution deadlines? A non-docketed bipartisan budget act cases will be resolved via a closing agreement, while docketed cases will use a stipulated decision. Now, no extensions beyond the 90-day period will be granted. Now, as I say, because it's an IRS program and you're doing a settlement, does that mean you won't get a settlement if you go beyond this date? IRS wants you to believe that, and certainly that'll probably be their position. Maybe you can, but of course, you're rolling the dice. This one, you know what you get. Now, if you miss the initial 90-day mark, there is a 45-day subsequent window. But the terms aren't as nice, right? The settlement terms in this window do remain generally the same, with one major exception. That 10% penalty just became 20. The extra you're going to pay is going to be 20%. Now, once that combined 135-day window closes, this settlement opportunity is gone, and cases will only be resolved based on hazards of litigation. And of course, the IRS wants to keep reminding you that they're winning these cases big. So they might not think there's much hazard of litigation. The IRS has publicly stated, in fact, that the hazards of litigation settlements typically reflect a meager 5 to 7% charitable deduction and fully put back in the 40% gross valuation misstatement penalty. They're going to offer you what they're getting in court. That's effectively what it is. So bottom line, yeah, if you don't do this, we can save you the cost of paying for the attorneys to litigate it. But you're going to have essentially the same result that you probably will get if you litigate it. That'll be our offer. And obviously, if you're going to take that offer eventually, then you were stupid not to take this one. Right. I mean, you got to have a plan, right? You know, the partnership has to have a plan. And sometimes you worry their plan is just, we don't want to tell the partners yet. We don't want to tell the partners, hey, you're toast. And maybe the promoters can somehow get out of the country, become uncollectible in the interim. I mean, I am a little skeptical sometimes about, why some of these cases got pushed as far as they did. I mean, I can understand, trying to negotiate a settlement. I don't know I understand actually going to trial at this point, given the results in these cases. I mean, yours has got to have something majorly different about it. Or I think you're probably losing big. It just is the way these are working. Or you got some amazing argument that you're going to present to the Court of Appeals that you go to that's going to somehow change the day. Maybe they do. Better hope they do, because right now the results are really bad in the tax court. Okay, what about the mechanics by the partnership? It changes depending upon whether your particular case is governed by the TEFRA regime, which is generally for 2017 and earlier, or the Bipartisan Budget Act, which is generally 2018 and later. So for those under TEFRA, the IRS will process the adjustments at the entity level. Individual investors should expect to eventually receive IRS notices saying specific amounts they owe after the tax court decision becomes final. Okay. If it's a BBA, 2018 and later. Under those rules, the tax liability falls directly on the partnership itself. If the partnership lacks the funds to pay, the IRS will send notices to the investors. If the partnership proactively elects to push out the liability of the partners, it must furnish those detailed statements to both the investors and the IRS describing the adjustments, which the investors must then take into account. So again, it depends upon which, in essence, for the most part, if you've just got an investor, you're kind of looking at which year is under exam. What year are they examining? If they're examining 17 or earlier, it's probably going to be the TEFRA. You're probably going to get, therefore, eventually an IRS notice telling you what you owe. That's pretty much it. You're going to know what you owe because we've agreed to the settlement. If you are a Bipartisan Budget Act taxpayer, then it's a little messier. It's possible the partnership itself will pay. Possible, but I think not likely, because I doubt many of these partnerships have anywhere near the funds available to them now that would allow them to pay this. That's just going to be your practical problem. Can they pay it? So either they'll push out the liability, or it's going to fall under the standard rule of where the partnership can't pay the imputed adjustment. We just go after the investors. Right? Under the BBA Act, that's essentially why you'd get notices, right? Because your partnership was unable to pay the amount they settled, and it would not be a good. Right, we're going to do that. So again, we have our infographic, as we said. This is the comparison chart, right? What's the key difference between what happens, if we're offered the settlement? Remember, we have the two windows, the 90-day window, right? Which, if we don't act within that, we're going to go to the 45-day window. And like I say, the 45-day window is going to be somebody may be looking at liability here under a claimed malpractice claim, I'm sure, at some point, or just, being incompetent running the partnership. Because the only thing that happens you get by going to 45 days is you pay twice as much in penalties. Now, if you go to 130, go beyond 135 days, you may be paying way more. That's a different problem. But we'll get there. Okay? So, what's going to happen here is, if you get the entity settlement, there'll be no deduction allowed for the charitable contribution. There'll be a deduction allowed for basically your out-of-pocket costs to the investors, and there will be a 10% misstatement penalty applied. If you go to the second tier, the late settlement, the 45-day settlement, then you're looking at a 20% penalty. The only real difference is the penalty is double. If you go beyond that point and go to litigation, Garris says if they will settle with you, which will be based solely on hazardous litigation, they're only going to allow you a 5 to 7% charitable contribution, and they're going to want the entire 40% gross valuation misstatement penalty. If you go to trial, right now, that last column looks like what you're going to get in trial. You'll just have to pay for the cost of litigating it as well. So, again, if you believe your counsel, if you're counsel for one of these and you do believe you got the case, right, you believe you can win, more power to you. And hopefully you do, because it would be nice to see somebody win. But do realize the risks involved. And if you're if you're advising, if you're not the attorney, but your client's in the middle and they're hearing this, I think you probably got to advise that, by not taking this, right now the risk is going from, you could get out of this for, you could quickly figure out what it's probably going to be their share for 10% for paying back the tax, you say, plus 10%. A little bit less than that because of, we will get the dollar write-off. So, paying back what you got for the contribution, less whatever the dollar amount we're given as a deduction, plus 10%. But if they go forward and don't settle, you're looking at a potential 4 times the penalty, and a charitable contribution will probably be right in line with what you paid, not way off. But still, you might get a slightly higher charitable contribution because they have allowed that in some cases. They say it's appreciated some, although not usually enough to cover what you put in. Because remember, they only gave an easement. Yeah, you need to understand the risks, and certainly if the partners are asked to vote up or down, it's right there. And tell them, I can tell you what's going to happen if these results take place. I can tell you what's happened in other cases that have gone to trial with results. I think I can tell you that. I can't tell you for sure that your counsel doesn't have the golden bullet. But I can't tell you they do either. So that's going to come down to, do you believe them? And more importantly, are they right? And that's a call you're going to have to make. I'm not counsel. I don't litigate tax court cases. I can't tell you for sure, or litigate before the Court of Appeals. I certainly can't tell you for sure how it's going to turn out. But client, you got to make the decision. I can't tell you. You want a sure thing, pay back the tax, pay the 10%, and you might find out that you didn't need to pay any of it. Okay. If you want to roll the dice to hope for that decision, knowing that so far that hasn't worked out well for most people, it appears, then yeah, you can go ahead and go with it. Just see how it goes, okay? That's basically it. So again, the primary advantage is no upfront payment requirement is a real change that's taken place under this program. Otherwise, it's really not that different from what they were offering before. If you don't want to face that really nasty non-waivable, that's everything. Remember, if you're representing them, you cannot get them out of that penalty at the partner level. Doesn't matter they acted in good faith. It doesn't matter they relied on you telling them it looked fine. Now, if you did, you better contact your carrier. I'll just say that right now. None of that's going to get them out of it. The 40% gross valuation misstatement penalty under 6062 is, for charitable contributions, a totally non-waivable penalty for which there is no reasonable cause exception. Period. Key to remember. But this is not the only way to file up a charitable contribution. Let's go to our third development. This is other charitable contributions, and this is not a conservation easement. This are 2 companion tax court recommended decisions. They're a pair of cousins, right? We have 2 Martin versus Commissioner cases, one involving Clint and one involving Stephen. Well, it involves Clint and Jennifer and Stephen and Amanda. But Clint and Stephen are cousins, so we're going to assume their relationship is what got everybody into this mix, right? We're here. And it's the Tax Court decision 2026-40 and 2026-39. Both were issued on May the 14th. Look, sometimes it's the simplest things that totally destroy a deduction. And this is a stupidly simple thing to comply with that has cost multiple taxpayers major money in terms of losing a charitable contribution deduction that everyone, the IRS, the courts, agree they otherwise would have gotten in full. This is somebody is getting a malpractice complaint area of practice. If you were involved and you didn't raise the issue and you knew or should have known, we've got some problems coming in. Okay? I'm just going to warn you because these cases are stark. Going back to, as I recall, the case was Durden, was the initial case that made it very, very clear how strictly these rules are applied. Right? What are we looking at here? The rules involving contemporaneous written acknowledgments required for the deduction of charitable contributions of $250 or more for a single contribution on the return. Bottom line, if you do not comply with all of the details, and there's both what must be in the acknowledgement, or it could be more than one sheet of paper. The courts have kind of indicated that's okay. They've got to be issued. They've got to say the exact things we have them say. They got to make certain statements. And number two, you have to meet a timing requirement. And the timing requirement is what is deadly. Because even though you truly gave a contribution that fully would qualify, you didn't get anything in return. You gave full value. If you don't have that statement before you file the return, on exam, you will lose that deduction unless the agent simply doesn't know what they're doing. I hate to be that blunt, but that's how it goes. And obviously, when you're examined and the IRS has told the agent to look at charitable contributions, they're going to ask to see this for every case where you gave more than $250 in a single contribution. And they're going to ask you for the acknowledgments. And if you say you don't have one, disallowed. If you give them one and they say, hey, there's no statement on here about what goods or services you got, you just lost the acknowledgement. You just lost the contribution. Even if the charity now says truthfully that you didn't get anything. This is how serious this is. And this has blown big contributions in the past. And in this case, it's going to blow not a huge one compared to some of the losses we've seen in the past, but not a small one either for most of our clients. Right? So what happened in this case? Cousins Clint and Stephen Martin purchased 13 1/3 acres of land in Highland City, Utah for $22,000 through a limited liability company. By 2018, 4 years later, they had jointly taken ownership and decided to donate the property to the city of Highland City. Okay. An appraiser came out, valued donated land at $665,000. Okay. On their 2018 tax returns, the Cousins claimed aggregate charitable deductions of $665,000 against a listed basis of $35,000. Now, again, that got the IRS's attention for the obvious reason that they want to make sure it really went up that much. But what the IRS discovered was they didn't really even need to worry about that. The IRS disallowed the deductions and moved for summary judgment, arguing the taxpayers failed to obtain a valid contemporary written acknowledgement, a qualified appraisal, and a proper appraisal summary. Right? The tax court noted right away, we only got to really decide one of these, because if we decide you failed the contemporaneous written acknowledgement test, you're going to lose the deduction even if the other two are pristine and perfect. That property is worth $665. right? And you got the proper appraisal summary. Got a qualified appraisal summary. The appraisal is 100% correct. Everything's perfect. You're still losing the deduction entirely. So the court's going to look at that first question. Did you have a contemporaneous written acknowledgment, or a CWA is how you'll hear it referred to, right? So where do we get these rules? This is in Code Section 170F8, and this is crucial because the code imposes this requirement and tells us if you don't meet it, no deduction shall be allowed. It is an absolute requirement. If this was a case where the Congress had said the IRS by regulation shall state what documentation shall be required, and you didn't perfectly follow regulation, then you can actually get where you could show you had what's called substantial compliance. You can miss the details and still end up with the deduction. It's best not to miss the details, but you still have a fighting chance. When it's Congress, the court's positions are identical to the IRS's positions. Neither the courts nor the IRS have the authority to override the rules of Congress. Congress says no deduction shall be allowed. That means I determine as a judge, you didn't meet these requirements. I have to throw out your deduction. No choice. Doesn't matter what sob story you got, no choice. Okay. Now, what's required? Well, you got to have for each charitable contribution, $250 or more. And that, if you give $10 a week to a charity for the entire year, well, you'll get to $520. That won't trigger these rules because the individual checks each week were $10. You gave weekly, you gave $10. However, if you give weekly and you give $260, then the CWA rule applies to every single donation. If you give, let's say, $200, $300, $400 on 2 or 3 special occasions during the year, let's say it's a church, you give on the major holidays, etc., you give bigger numbers, it will apply to those, but not your $10 ones. Okay? It does look at it that way. It's not looking at gross contributions to the organization during the year. It's actually looking at individual contributions. That's how the law is written. But if you trigger it, you have to have a CWA from the charity. Okay. The CWA must state whether the donee provided any goods or services in consideration, whole or part, for the contributed property. It must state, what you gave. If it's dollar, it got to tell us the dollar value. If it's property, it's got to give a description of the property you gave. It's got to state whether or not the charity gave you something. If they did give you something in exchange, they have to give the value of what you got in exchange on the receipt. And by the way, if they don't have to value the good, let's say property you gave them, you have to value property they gave you. That is required. Or it must state explicitly that you did not receive any goods or services, or you received only an intangible religious benefit. If you're a church, synagogue, etc., you have that line. Okay. This is meant, the court has said, it's justified under the law, it's not unconstitutional because it provides deterrence value, and because it's written by Congress, substantial compliance will never apply to excuse a defective contemporaneous written acknowledgment. So, key issue. Also, you must have this on or before the earlier of the date you filed the return, including extensions if you ask for them, or the due date of the return. That means on exam, you can't fix this. If we get to exam, and that's when we first discover the client does not have a CWA, you're hoping for an incompetent agent. That's all you can hope for. You're hoping for that because if the IRS goes forward, they do what they're supposed to do, that deduction is gone. Nothing's bringing it back. Bottom line. That's how the courts have ruled in this area, without question. So what did the IRS argue was wrong with what the taxpayers provided? There is no specific form for a CWA. A valid acknowledgment can be pieced together from a series of documents the courts have ruled multiple times. The taxpayers attempted, therefore, to rely on their Form A283, the non-cash contribution form, the joint letter with the mayor that they had, a 2018 deed, and for one of the cousins, a city council agenda. Now, while these documents describe the property, they fatally failed the consideration requirement. Precedent demands an explicit affirmative statement regarding consideration, even if none was given. The Form 8283 failed because it lacked this statement entirely. They are not going to read in implied nothing was given. It's not going to be our only problem in that area, but it's not going to be our only problem with this, because they had other arguments saying, oh, no, it effectively said that, right? Now, the joint letter with the mayor utilized terms like donation and gift, but the court ruled this legally is insufficient to substitute for an explicit statement. The law requires a statement you got nothing. We're not going to assume you got nothing because you made a donation. A donation does not necessarily imply there was zero consideration. Let's say I make a donation to a charity. Like, you have these charity auction situations where you grossly overbid for something, right, to benefit the charity. So I bid for whatever piece of property was. I bid $10,000. I get the piece of property worth $1,000. I made a $9,000 donation. I made a donation. But my donation for tax purposes is going to be limited to the amount I gave up reduced by what I got in exchange. That's going to be key. So that vague language didn't work. Well, they had another defense they're going to try. This looked at language that was actually in essentially the deed. Now, in this case, the problem here is going to be boilerplate language. Now, if those remember the 2022 case of Albrecht, their boilerplate language in a deed of gift. In the case of the Albrecht case, it was gifting various items to a collection in a museum. And the deed gifting those items said essentially that this deed constitutes, the entire agreement between the parties. No consideration was given in exchange for this, I guess was how it was written, except as provided in the gift agreement. There was no gift agreement. There was boilerplate there that allowed you to kind of like paste one on without having to modify the deed language. But nobody took it out. You're in the same trouble here. And this time you're probably going to see language that you've seen before on documents, right? This warranty deed, which is a simple way of transferring the land over, that conveyed the property had the standard boilerplate real estate language stating that the property was conveyed for and in consideration of the sum of $10 and other good and valuable consideration. That's generally in there, as I understand it, to prevent the cousins in this case from arguing that, there was no consideration, therefore no contract, therefore no transfer. So we lie effectively. But it's boilerplate. And that boilerplate in there prevents the action. So it's in there, but here's our problem. Because the deed explicitly recited the consideration and lacked a merger clause, it destroyed the validity of the documentation as a CWA. Right? Here's the problem. That language says exactly the opposite of what we want to hear. It says we got something and it didn't value it. It's totally wrong. The first clause for $10 would reduce our deduction by $10. That's not really a problem. But other good and valuable consideration. Remember I said you had to value what you gave them? There's no value there. deadly. Okay. There was no merger clause that said the other this other document contains all details, right, involved in this. Now, the taxpayers are going to use state law. The court should read a merger clause in the agreement to fix the issue, stating that there was no other agreement and that should just be incorporated by result into this statement in the deed. The tax court is absolutely no way, right? It's not going to look beyond the four corners of the CWA, right? Four corners meaning what's literally in the document, to save the deduction. The court warned that ignoring or reworking the standard statements in deeds to create a valid CWA was introducing substantial compliance doctrine, right, into a statute where it absolutely does not belong because Congress wrote the law. They wrote a statute. They didn't say getting close was good enough. We have a problem. So, bingo. Our key takeaways then from all of this? Well, ultimately, the tax court granted summary judgment in favor of the IRS, resulting in total disallowance of the $665,000 charitable contribution. Right? Now, you got to reiterate to your clients that the doctrine of substantial compliance is never going to rescue you from a defective CWA. Period. You cannot. You've got to do this on totally. That also means, though, that you as a tax professional or whoever is involved in this contribution, who is as tax background, has got to double check that there is a true proper CWA. This all could have been solved by a letter from the city to the cousins, each cousin indicating that, you gave me 1/2 interest in this piece of land. Don't have to value it because that's not the city's job. And in exchange for that, you received no consideration. No goods or services were provided to you in exchange for this amount. Now, of course, it's going to freak out some real estate attorneys, I'm sure, because, oh, man, you're disavowing, the statement and, this all could. No, okay. You need to work around that, but for tax purposes, that statement is deadly, right? So it's not going to rescue the case. And I don't really think it's going to blow up the deed. Again, I shouldn't say that, I guess. I'm not an attorney. But I have a feeling courts will be, on this case, saying, look, that's standard language. It's meant to just stop them from asserting that they should really own the land because there was no consideration given, or other parties challenging it that way. Yeah, we're just saying, yeah, that's good enough for us, right? We understand this. So I need the letter, right? You got to carefully police the legal documents at the closing. Watch out for things like a standard clauses that is reciting consideration. $10 and other good and valuable consideration is a destructive term, right? That, especially standing by itself, is going to destroy the deduction, right? So if you want that deduction, we got to come up with another way to convey it. Right? We got to come up with another way that's going to be legally okay to make that donation to the city, rather than using the warranty deed and using that standard boilerplate language, which unfortunately sometimes our clients don't get legal counsel involved. They just go down to some shop that sells legal forms, or go to LegalZoom or whatever, and get a standard boilerplate warranty deed. By the way, this should be a great example about why there is value in a professional, even an attorney. I know somehow tax professionals sometimes think like that, we should be paid, but the attorney shouldn't. Yeah. A tax attorney, or frankly, you should note that boilerplate is a huge problem. Right. So we need that. You need to cure this by ensuring a perfectly drafted, separate CWA is obtained that contains explicit affirmative statements confirming the absolute absence of donor consideration. I also mentioned that one of the cousins tried to rely on city council agenda. There, the court went to something that's also been used before. The court said that even if that agenda, which indicated the city would pay nothing out for, to receiving this property, that could not be an acknowledgment for one very obvious reason. The obvious reason you can't acknowledge an action until it's taken place. An agenda is before the meeting. Perhaps if you had minutes of the meeting, official minutes, that did say and was provided to, maybe you and provided to the cousins, maybe you could convince the court that that was good enough, that acknowledged that X was donated by, the donor, right? One of the two cousins, and the city gave nothing in exchange. Of course, gang, my theory on that, though, would be to ask, why even try that? Problem one is, unless you had that before you filed the return, you can show that. That's not technically a CWA yet because you didn't have it. And secondly, it's like, just get the letter. Just get a letter. I am going to suggest that it's very likely nobody ever asked for the letter. Nobody realized that deed wouldn't work. Even though if you followed these cases going back to Durden, anybody who does this, who works a lot in the charity area and knows about and is known about these rules from day one, would immediately say, that's not going to work. We need the letter. Get me the letter. And I've had to argue with charities to get the letter. It's okay. No, it's not okay. We've had people examine. That's not okay either. I don't care. Incompetent agents exist. That doesn't mean that the one that examines my client's return is going to be incompetent, so I want the letter. And third, I started asking, why are you fighting the letter? What's wrong with the letter? Because, hey, I'm just asking for a letter that says these three things. Unless they're not true. If they're not true, then no, don't sign the letter. But then again, if they're not true, then, yeah, I got other problems, right? We're going to go here. So again, got to be very careful with these cases. And one other thing I'll add, if the donee, if the charity is a donor-advised fund, please remember, under, I believe it is F17, there is yet another statement that must be in the CWA. A CWA from a donor-advised fund must indicate clearly that the donor-advised fund retains full discretion to determine where funds given to it will finally be contributed. What's going to happen with those funds? You cannot, if you leave that off, it's presumed that your donor has a legally binding right to force the DAF to give the money to the charity they tell them to, which, by the way, I shouldn't even say it's a presumption, it's just you can't overcome it. You're going to lose. You've got to have that. Oh, by the way, a few years ago, somebody tried to sue Schwab DAF because the DAF refused to give to whatever they were insisting they give to, which I don't think was even a qualified charity. And they sued them, claiming a violation of contract. And as the court pointed out, if you truly had a contract that said that with Schwab, you wouldn't have had a charitable contribution to a donor-advised fund. That's not allowed by the law. Whenever you use a DAF, they have to retain the discretion. And that means they have to retain it, not just paper it over, they have to retain it in fact. And yeah, the court was not about to grant a donor a win on that statement. Right? Because if they grant the win, it would have actually put every single Schwab and probably every single donor-advised fund contribution at risk. If it turns out that the courts have now ruled legally the DAF has to give the money to the charity it was granted to. Now, there could be a different theory if there was an abuse of discretion by the charity, and they just kind of intentionally sent it someplace, and did not give adequate consideration to the suggestion of the donor. Might be able to make that work, but you can't make it work by simply saying they have no choice, they have to give it where I told them. Yeah, that didn't work. Make sure the DAF does that. I have seen that missed on DAFs. And remind a DAF, I don't care what your website says, you can't acknowledge a contribution until it's actually made. Hey, we have a nice little don't lose your deduction infographic here. Kind of explains this. You could use this to explain to a client too about what needs to be in there, when they need to have these, what the content is, and that how quickly they've got to have that together. This says the return is filed or due, right? I just tell everybody, by the way, you should tell your charities about this too, because a charity can get in trouble for not issuing these. In essence, their donors will be upset. Shouldn't you guys have known this was required? Why didn't you include the right statement? We also have a few other substantiation rules there. The appraisal rules. Now, again, we never got the appraisal in this case, didn't matter. And it might actually be good news because that 40% gross valuation rule that we never got to. But we're there. Okay, that's where we're at. Okay, let's talk about now our fourth and final development. This is the Federal Circuit Court of Appeals decision in the Dillon Trust Company, LLC versus United States, which was an appeal of a Court of Claims case. The Federal Circuit issued its opinion on May the 14th of 2026. This is a highly cautionary tale if you're handling the sale of closely held C corporation that holds appreciated assets and you're approached with a structure that can let your clients get the full value of the property inside the C corp, even though they're only selling the stock. Let's quickly review how C corps work. In a C corporation since the 1986 Tax Act, we've not been able to escape the double taxation problem. Generally, we can do a little bit of a 1202 stock. Not talking about that here, so we're not going to worry about that. But generally, we got rid of that problem. So what's going to happen is, let's say I have a building inside a C corp. Let's say it is exactly the building that our prior taxpayers were trying to give away, that property. So it's worth $665,000. We only paid $22,000 for it. Let's say I paid $25,000. So we got a $640,000 gain. Now, that corporate gain, when we sell that property, if we sell the property directly, we're going to have a $620,000 gain, right? $640,000 gain, I should say. 665 minus 25. That $640,000 gain is going to be subjected to the corporate tax at 21% federal, and then potentially a related state income tax. Depending on which state it is, that number could vary, but somewhere from 0 to, let's say, 10%. I think there are a few even above that for corporates. So I'm going to probably lose, let's say I could conceivably lose 1/3 of the value to taxes, right? Maybe a little bit less. So let's be a little nicer. Let's say that I lose not quite 1/3, but I'm going to still lose $200,000 of the value. I'm going to now have 400 and, so now instead of $665,000, I have $465,000 already reduced. And when I then liquidate the stock, because the cash inside the corporation, otherwise I'm going to have a personal holding company very quickly. If I just hold the cash in the corporation, invest it, I'm then going to have on my own personal returns the liquidation, which means I probably paid $25,000, right? I gave the land to get the stock. So I paid $25,000 for the stock. For instance, that's my basis. And I have $465,000 of proceeds to redeem it. So I'm now going to pay tax on $440,000 at probably 23.8% federal, again, up to 10% on the state. And you suddenly see I'm going to get whacked again for maybe another 30%. I end up with way less money than the $665,000. If I could sell the stock and the party buying it from me was willing to pay the full value of the land inside it, which they shouldn't be willing to do, by the way. But if they were, then of course I would just sell it for $665,000, have a $640,000 gain, and only lose 30% of that, right? I'd now have essentially eliminated the second tax. So, what happens in these cases, and this was promoted heavily a few years ago, right? To achieve a single level taxation that sells stock to an intermediary entity, an entity that was created for this purpose. Thinly capitalized, right? That bought the property from you. They bought that they bought that for 665 with a loan they got that was collateralized by the property, right? So they did that. They then sold the property to a third party, used the proceeds of the sale, right? Effectively to pay off the loan. Oh, and by the way, in addition, you paid a fee to get this transaction to work, so it's all great, right? And it took care of their deal with setting that up. So bingo, you get the 665, right? They, in essence, establish this unrelated company from you that then buys the property, sells it, has to pay off the loan, so they have no cash left. And oh my gosh, we have nothing to pay the income tax with, IRS. So sorry. Ladies and gentlemen, welcome to the world of transferee liability. And that's how the IRS has successfully attacked these cases. Dillon Trust is a case, has a few other features, but that's the key aspect here. So what happened here? The Dillon family trust held C Corporation stocks with asset valued at 665 was 90 million. But internal tax based only 16 million. There is $71 million of unrealized built-in gain. An asset sale would have triggered that crippling double layer of taxation on that gain. That's going to reduce dramatically what the trusts get in exchange for selling off the assets. They're going to get $90 million for that and only pay tax maybe on less their basis in the company stock. They're going to pay first tax on the inside basis gain of $71 million at the corporate level. That money is going to disappear. And then again, when they liquidate their interest in the corporation, we're then going to again tax their gains. So this is bad. We like to get around bad if we can. Now, one problem they have is they actually had advisors that, kind of was saying, hey guys, some explicit warnings here, right? Their tax counsel, the sophisticated tax counsel, advised the trust to pursue a stock sale, but warned against selling to intermediate entities using loss-generating tax shelters, pointing to the dangers that were then outlined in IRS Notice 2001-16 that told taxpayers the IRS did not believe these worked, and they would aggressively pursue them. They were told, don't do this. In essence, you are really, really subject to attack if you do. Despite the clear warnings, the trust proceeded to accept a bid from a newly formed shelled entity, HS8C, for 95% of the net asset value. So they only took a 5% haircut, right? Okay. Now, here's the catch. Now, the theory of these was, well, I don't know what they're going to do with it, right? So I don't care, but they took the stock. So, maybe they're just fine. Maybe they're going to actually use the building forever. They're never going to sell it. They don't care. Then wonder, didn't they care about law? But I'll get the word out. Didn't they care about not getting depreciation on the building? That $71 million worth of depreciation they're giving up because it's going to come in at your basis, not at, or we're going to have to do the corporation's basis, not yours. And I'm going to bet a good chunk of that, especially if it's things like real estate, is raw land. The buildings have been heavily depreciated. So, and yet they've got huge value. So even if I was going to use it, it's not obvious why I would pay 95% of the fair market value or the net asset value of the company. Why would I pay that much? Right? And this is where the courts and the IRS come after them. Paying a premium for built-in gains is economically irrational for an independent buyer. Furthermore, that shell entity funded the entire purchase using a loan completely collateralized by the purchased assets. It had no other assets. It got $124 million simply by pledging the assets. So it has nothing but the land on its books when it sells the property. It's going to have a realized gain. It's going to have, unless there is some loss used to offset those, and these companies swore they had some way of magically importing an NOL into this entity. Hint, it never worked. Right? But you would say, well, that's not my problem because I didn't do any of those transactions. It's not my deal. But the problem is, under transferee liability rules and under the IRS assertion of this, you should have known that corporate tax would never be paid. They were going to sell the property, that corporate tax never be paid because a rational buyer would never have paid you 95% of the value of the assets when all they're getting is C Corp stock, and those assets have $71 million worth of unrealized gain in them. So what the buyer's scheme was, now we can lay it out. Immediately upon closing the stock sale, this buyer sold off the investment portfolios and assets to pay off its loan, generating a $73.2 million gain. To eliminate that resulting tax liability, the buyer engaged in abusive son-of-boss transactions to manufacture a $74 million fictitious loss, which perfectly offset the $74 million fictitious gain, which zeroed out the tax. Those of you who are around for son-of-boss know how that failed, how that fared in court. Yeah, both boss and son-of-boss failed. Spectacularly, I think is a good way to phrase it. We don't get into how they worked. Well, they didn't. We don't get into theoretically how they worked because it's not relevant now. And the courts have been very clear it doesn't work. But in any event, that was it. And at the time, you already knew the IRS had son of boss in its sights. They were looking. By the way, also should have been a clue when boss was overturned. The mere fact that the promoters, the people pushing this, just simply changed the naming to son of boss might suggest it's just as flaky as the first one. Might have. You probably should have thought about that, but okay, people did. The IRS subsequently audited the transaction, determining the losses were artificial, and assessed $25.6 million in income taxes along a $10.2 million gross valuation misstatement penalty. Hey, it comes back again. We love that one. So now there is $35.8 million of unpaid taxes plus interest. That's rolling up. Now the IRS goes after the sellers, the Dillon Trust, because the shell buyer was predictably insolvent. You had to be willfully blind not to realize that. Remember, they'd been warned about this exact structure by their counsel. And it helps to pay attention to your counsel. I think that's a good hint. But they've been warned. We don't think you should do this. Sometimes as a professional, you tell clients not to do something and they do it. That apparently is what happened here. Because they were predictably insolvent, the IRS issued transferee liability notices back to the selling Dillon Trust, leaving them on the hook for the entire unpaid balance of $79.9 million. This is getting even worse, right? We had $73 million worth, $71 million worth of gain. We're trying to get out of paying taxes on this, and now the IRS wants a check for nearly $80 million. Taxes, penalties, and interest. Can they get it? That's the key question. Well, under Section 6901 of the Internal Revenue Code, procedural mechanism for collecting unpaid taxes from a transferee substantive liability is determined by underlying state law. In this case, New York's Uniform Fraudulent Conveyance Act. This is really bad news because the major case in this area that started all this number of years back was a New York case. So it's like, oh gosh, we're going back to this law. Tax court's already been through this. We know how this one's going to work. Okay. The Federal Circuit utilized the Diebold framework from that first time to collapse the multilateral stock and asset sales into a single fraudulent scheme. The core of the ruling was that the selling trust had constructive knowledge or inquiry knowledge of the fraud due to their willful blindness. They simply didn't pay attention, right? They were, as we say, willfully blind. In essence, you cannot play ostrich and bury your head in the sand. They were willfully blind because their attorney told them this is what these people are going to do. And if they do it, the IRS is going to come after you. We see the dots were kind of connected already. That's bad. Right? Now, the court found this blindness unreasonable. The trust accepted a bid for 95% net asset value, despite $26 million of built-in tax liabilities at corporate level that they know they would incur if it was sold today and they just took the money out. Right? They know that. It is economically irrational for an independent buyer to pay a premium for built-in gains without a discount unless they plan to illicitly evade the tax liability. In essence, you got to ask yourself, is there any legitimate way they get out of this liability? They're setting up a brand new entity that has no other assets. Tell me how we're getting out of that. Right. Furthermore, the buyer was a newly formed shell entity operating entirely with funds borrowed against the target corporation's assets. Therefore, as soon as they sold those assets, they had to pay the lender. Lender was first in line. That thing would have no money to pay the income tax. So, buyer, you either knew they wouldn't be paid, or you made yourself willfully ignorant. You didn't want to know. And you should have asked. This is not a small set of trusts. This is not a little tiny transaction. These are not unsophisticated taxpayers. Yep, they should have known. So what did the taxpayers try to defend against this? Well, the trust attempted to argue they had no duty to inquire beyond the buyer's post-transaction plans because the buyers claimed those plans were proprietary, the ultimate defense of a bad tax shelter. I can't tell you how it works because it's proprietary. By the way, proprietary means you can't show it to anybody who would tell you what a bit of garbage you just bought. That's what proprietary means. Well, in practical purposes, it's what it means because 99 times out of 100, the proprietary plans fall apart and the court absolutely put them through the ringer on the proprietary defense. The court rejected it entirely, characterizing accepting of this excuse as monumental naivety, gross negligence, or at best a hopefully useful fig leaf was your approach. So either you're incredibly naive and stupid, which I don't buy, you're grossly negligent in what you did, and you're not going to get out of it being that, or you were just hoping to paper it over with this. And we're not buying it. Sorry. You can't get out of it, because remember, this is a fraud statute, right? In essence, transferee liability was essentially an attempt to defraud a known creditor. Is effectively what it is. You knew there was this out there, and you entered into a transaction that you knew would essentially leave them high and dry. That's basically the structure, right? Now, the taxpayers tried to cap their liability under state law, which protects purchasers acting without fraudulent intent. This transaction, here's the catch. The court said this transaction was deemed constructively fraudulent, and that included you, right? The court ruled there is no statutory cap. Every dollar they got, $124 million, that did not go to the IRS to pay not only the taxes, but the penalty and the interest, you owe that much to them. You owe them. Right? You need to pay it over. Now, the court did address a circuit split and sided with the 1st, 9th, and 11th circuits. So, in this case, Federal Circuit, 1st Circuit, 9th Circuit, 11th circuits held that transferees are retroactively liable, not just for the taxes, but for the interest and that $10.2 million gross valuation misstatement penalty up to the total value of the assets they received. Now, outside of those circuits, either we have contrary holding or we don't have a holding. Unfortunately, as the First Circuit just proved, the mere fact we don't have a holding, and by the way, that may very well be, in essence, it might have been this case would have gone, at least for certain cases, for certain trusts, to one of the circuits we knew would hold that. So we tried the Federal Circuit. The Federal Circuit didn't help you. By going to Court of Claims, you didn't help by getting there. So, yes, they owe the interest and the gross and the penalty. As I said, there are a few circuits, I wouldn't be surprised if one of them was a fifth, that would say, no, it's just the taxes. But be aware we've got that, and if it becomes a significant issue, the Supreme Court might pick it up, and the court may very well go along saying, nope, it's fraud. As far as we would interpret this law, that is a fraudulent statute, and the federal law would capture then all rights you'd have under New York law, which would be this. Finally, there was a little problem with the interest. The Dillon Trust attempted to halt the accrual of approximately $11 million underpayment interest, making a $71.7 million deposit under IRC Section 6603. Now, here's where we got in trouble, because the original trust, which were subject to the assessment originally, had terminated. Successor trusts made the deposits. This is a mechanical case, but it's a problem. The IRS refused to apply deposits made by successor trusts to tax liabilities of the original trust, stating procedures do not allow one taxpayer to direct a deposit to another taxpayer's liability. Even in this case, where probably those trusts would have to have been the source of the funds, there'd be a secondary transferee liability problem, right? The Federal Circuit read the statute strictly because 6603 states a taxpayer may make a deposit, and it may be used by the Secretary. The court noted the IRS has broad absolute discretion in choosing when and how to apply deposits. The IRS did not act unlawfully in refusing to interchange deposits between distinct legal entities. Therefore, they did. Now, as I recall, when they refunded the deposit to the trust, they did pay interest on that. But then they charged underpayment interest, to the trust on the balance was sitting there. So they didn't really stop the interest. That was bad news in a procedural mix-up group, but yeah, that's it. Okay, so now the infographics to tie all this together, right? All these things. This is what was known. The term was used as a midco transaction, was this sort of shelter. Where we brought intermediary, this midco that was created, just to acquire the stock, sell the assets, and liquidate. Okay, and midco itself would be insolvent, right? It wouldn't have it. Now, our initial strategy was to, avoid the double tax by selling the stock. We sold it to a thinly capitalized intermediary that would be unable to pay the income tax to. The intermediary had a theoretically proprietary system that was going to allow them to escape the tax entirely. And you don't need to know about this hint. If I'm selling to you and you're paying me 95%, I need to know about it. Bottom line, non-negotiable. You want that fee, you got to put this thing out there. Right? You got to give me the issue and allow me to have my legal counsel rule on it. Yeah, and I will agree, I will not give them any permission to release that information, right? To third parties. So they're not going to be the source of disclosure. They're subject to disclosure rules. But I'm going to have my counsel review it. Period. I'm going to have my tax pro review it. Period. If you can't do that, then I'm sorry, you need to go find somebody else. Because as Dillon shows, just ignoring it because it said the magic word proprietary is not going to work. I am totally serious when I say that magic word proprietary has been for me through the many years I've been involved in taxes, a huge red flag indicator that what we're talking about here is probably not going to hold up under scrutiny. And by saying proprietary, and I can't tell you, is a great way to make sure we don't scrutinize it. We need to scrutinize if we're going to rely upon it, because we're relying upon it. Okay. So what they found was constructive knowledge. As the little infographic shows, there was a bunch of red flags that they were ignoring. All right. You can't play that just, cover your eyes and I don't want to know. No. your counsel knew. Your counsel told you not to do this. They told you this would be a bad idea. They told you how these things are structured. And they were totally right. Amazingly, they knew the proprietary structure. Isn't that amazing? Yeah, it's so fancy and so, shall we say, so fancy and so much that no average attorney or CPA or EA would ever have thought of it. That just, it's just, you've got the world's greatest genius counsel, greatest genius tax counsel. Let us all know who it was, because that's the smartest attorney in America. They derived this magical proprietary, super complex, we can't tell anybody structure. And they even knew about it before you even told them about it. And they told you that the structure would fail in court. Ladies and gentlemen, that is America's most intelligent tax attorney. We need to know the name, and we need to get them involved with our clients. Let's just phrase it that way. That was it. Or maybe just every tax attorney would have come to the same conclusion and told you the same thing. I'm leaning a little toward the second article. I think that attorney, no question. The attorney or attorneys are very, very competent and very intelligent. Right? But I think even they would say they weren't the only people in the country that figured this thing out and figured out why it didn't work. Okay, so basically here, financial outcome, they were so far worse off than had they had just sold the asset. They got nailed for everything. This is not good. There's no way around that. By the way, they still would have been liable for interest because the transferee liability interest would have still come after them. It's not like they'd have gotten totally out of interest, et cetera, because they owed the money over and now they're not paying it to the government. So I think the penalty was the big thing. The $10.2 million penalty was the real problem. That theoretically in some circuits you might get out of, but again, we just don't know. They were far worse off having done this. What could I lose? Tax shelter. What could you lose? Millions more than you ended up would have paid anyway. And effectively, you essentially got, when at the end of the day became close to zero value. You basically maybe got your basis back. That was about it. That was your problem. Well, we can close out this week's session. Remember, we had our themes today. We were looking at the strict dollar limits of the new and accepted fertility benefits and that are potential, not yet in place. Please keep that in mind. We looked at the conservation easement settlement options and, what they are, how they're different from what we had before, and how things accelerate toward much worse results if you don't accept it. As I said, really your client's choices. The partnership either accepts this or your client as an investor has got to hope that you have found. I wonder, we're looking for the most intelligent tax attorney in America to find the magic system. Hey, go talk with the trust. They found somebody who might just be this person who probably wouldn't go near these, but that's okay. That probably tells you the most intelligent tax attorney in America wouldn't go near them. Yeah, I think that tells you everything you need to know, but let's skip that. Nevertheless, hopefully you've got the most intelligent tax attorney in America who has found the magic bullet, right, to make your conservation easement partnership work. And you therefore get to keep all your tax savings. We'll hope for the best. That's kind of how we could do it. The key problem of the CWA, I bring that up because it just keeps happening. Charities have a responsibility to know this. That includes city governments because they're considered a charity under these things. But, tax advisors have to tell their clients about the need for CWAs. And certainly, I would say for most of us who are advising somebody preparing a return or advise them on a contribution, we want to see the CWA, right? Because we should know that as ridiculous as it seems, that requirement to get the one piece of paper I need to deduct a $300 contribution, to the American Red Cross on my individual return, that stupid little paper that got me a $300 deduction and maybe saved me at the top end $100 in tax. I absolutely need that for a $90 million contribution. Or in this case, it's $65,000. Right there. And looking at the danger of transferee liability, you cannot play stupid. If you're getting out of a tax liability by transferring it to somebody else who is buying your assets and yet not discounting what they're paying you significantly more than 5%, that tax will be way more than 5%, you have a responsibility for how in the heck is this working economically? Because your liability is going to depend on having understood that thing's solvent. I'm not setting up a situation where there will be tax actually due to the IRS that won't be paid because of a structure that I either knew about or should have known about. That's your problem. As always, my email address is there on the slide, edzollers@contemporaneous.com. You can contact me, basically via that address or via the state societies for Connect sites where I'm known to hang around Arizona, New Jersey sites quite a lot. Also, we'll look in on Idaho, Minnesota, Illinois, and Washington. So you can post things there. I won't necessarily respond to everything, but if I see something I think I could be helpful with, I'll probably post at least my ideas there. Otherwise, we're going to get ready to see you back here next week, as we're going to probably see other neat new things happen as we come into another week of current federal tax developments.